All right, let's get right into the December 16th closing print. If you felt completely whipsawed today, well, you weren't alone. The data confirms it.
It was a day of just massive tension hidden by these tiny, tiny index moves.
Exactly. Let's hit the scoreboard. The S&P 500, it closed down 0.15%.
Barely moved.
The Dow finished down 0.20%. And the Nasdaq Composite, it edged lower by a negligible 0.05%.
Which is, I mean, that's the perfect definition of a choppy mess. Complete gridlock.
So what was driving that? It felt like paralysis.
It was primarily driven by, some conflicting Fed commentary that hit the wires, plus this extreme hesitation ahead of tomorrow's inflation data.
The CPI number.
That looming CPI number put the entire market into, risk paralysis. Nobody wanted to make a big bet.
And you could see that lack of conviction immediately just by looking under the hood. We didn't see any kind of broad buying. We saw defensive rotation.
Felt like to safety.
Utilities, the classic safe haven, led the charge. They were up a solid 0.8%. Investors were clearly looking for a place to hide.
Absolutely.
Yeah.
And on the flip side, where did the selling land?
Yeah.
Technology. It lagged the market, fell 0.6%. So all your high growth, high beta names just stalled out completely.
So the growth engine just sputtered.
It did. And if we zoom out a little, that cautious tone is it's undeniable. Our own institutional analysis shows the US 500 fell 0.27%. But here's the number you have to internalize.
Okay.
While the NASDAQ headline barely budged, the underlying institutional flow, the big money, it showed a much sharper decline. That basket of stocks was down closer to 0.59%.
Wow. Okay, so that is the first major red flag right there. The headline index is being propped up, but the smart money was actually selling tech and selling it pretty aggressively into the close.
Right.
Which brings us to the core question. Was today's move, tiny as it was, backed by real money, or was it all just noise? We need to see the volume confirmation.
You have to. If the volume isn't there, the price action is suspect. If the volume is high, you know the action is deliberate.
And what did we see?
Overall, conviction for a big rally was, well, it was certainly lacking. SPX and Nasdaq volumes were a bit below their 30-day averages, but we saw immense, very focused activity in specific pockets.
Pockets like AXT, it saw its trading volume jump. What was it? An incredible 74% higher than its recent average.
That's a huge spike. And that massive volume surge, it confirms heavy, sustained selling pressure. It just completely overrode any little bit of intraday strength that stock had.
So no broad conviction for buying, but very high conviction selling in certain names.
Precisely. Now let's talk about institutional flow, because the divergence here, I mean, it gives us a really clear window into global risk sentiment right now.
Okay, so let's use the Indian market as a proxy for how global institutions are positioning, especially around those riskier assets. What happened there?
So the foreign institutional investors, the FIIs, that's the foreign money, they were net sellers. They offloaded roughly 2,400 crore rupees worth of assets.
That's a clear risk-off signal.
It's a huge risk-off signal. Global players are trimming exposure, they're tightening their belts right before this CPI print.
So foreign capital is heading for the door. But the whole market didn't collapse because the domestic players stepped in?
They did. They provided an offset.
Yeah.
The domestic institutional investors, the DIIs, they bought over 1,070 crore rupees. But the net institutional effect was still a loss. About 1,300 crore rupees flowed out.
And that divergence is the key. Foreign money leaving, domestic money trying to hold the line.
It's crucial. And it perfectly mirrors that reversal Monday pattern we saw in the U.S. You had this institutional doubt that led to them consistently fading any little pop during the day, especially in tech.
They were using any strength as an opportunity to sell.
Exactly. They see a rally as a chance to get out, not a reason to jump in.
That fading action is just the signature of doubt, isn't it? And it leads us right to our next point, the indices. They look calm on the surface, but let's lift the hood and see the engine sputtering underneath.
The internal?
We have to check the internal health of this market. And that brings us to market breadth, which is, I think, our biggest red flag of the day.
Breadth tells you if the whole army is marching together or if it's just the generals, those mega cap names that are moving, and if it's only the generals.
You have a fragile formation.
An inherently fragile formation, yeah.
So on the NYSE, the main exchange, the action was kind of weak but neutral. You had advancers and decliners running pretty much neck and neck, a 1-to-1 ratio.
So stalemate, no conviction either way.
Right. But then you look at the NASDAQ composite, which, remember, closed slightly higher on the headline. The internals were just terrible. Decliners massively outnumbered advancers.
What was the ratio?
It was almost 2-to-1, specifically a 1.76-to-1 ratio.
So what for you, the person listening to this, is absolutely critical here. This divergence means that only a tiny shrinking group of mega-cap tech giants were doing all of the heavy lifting.
The entire index gain was basically manufactured by those few names.
Exactly. I mean, that's not just fragility. That's massive concentration risk.
So if the market is leaning on just one or two huge stocks to hold everything up, I mean, what happens if one of them has a bad day or institutions just decide to take some profits?
The whole floor gives out. The entire index support just collapses. You can't mistake these tight index numbers for underlying health. This is why we're saying caution is so warranted right now.
And that leads us straight to the fear gauge, the VIX. Did uncertainty actually go up on a day that barely moved?
You'd think it would be flat, right?
You'd think, but it absolutely did. The VIX closed higher today at 16.78. That's up 1.70% from its open, and noticeably up from yesterday's close of 16.50.
So the market is buying insurance. Just think about that. The indices are flat, but volatility is creeping up. You combine that with that terrible breadth we just talked about.
It's a bad combination.
When volume increases on a sideways day, it's a signal of underlying unease. It's subtle, but it's a powerful warning against getting complacent.
So institutions are sensing that this structure, this reliance on just a few big names, is unstable.
And they are getting ready for a potential drop. They're hedging their bets.
So the market is clearly bifurcated. It looks calm on the surface, but there's chaos in the internals. So let's pivot. Let's move from the big index story to specific price action.
Yeah. When the broad market is a mess like this, that's when you find the clearest setups.
Exactly. The focused, high-volume action is where the opportunity is. We need to identify these key reversals for potential day two momentum.
These stock-specific narratives are so vital because they show you where capital is genuinely flowing, whether it's in or out, completely separate from the S&P's inertia.
Okay, let's start with a bearish one, a high-conviction reversal. AXT, ticker AXTI. It closed way down at $13.67 from $14.83. We already mentioned that 74% volume surge. Explain why that volume makes this a high-priority short setup.
The volume is the validation. I mean, a big drop on light volume, you can maybe dismiss that. But a huge drop confirmed by 74% higher volume. That tells you institutions, the real money, were aggressively dumping that stock into the close.
So they created that strong intraday bearish reversal.
They did. And that sustained selling pressure is what makes AXT a prime candidate for a day two continuation short.
Okay, but the rotation wasn't all negative. We have to look at some of the bullish signals that were emerging. Let's take Hydrogen Utopia, for example.
Right. So Hydrogen Utopia had a gap up at the open, and then it failed to fill that gap all day. This created what we call a classic bear trap reversal.
So sellers tried to push it down.
They tried to push it back down, but the buyers just completely overwhelmed them. It showed incredible resilience and accumulation right into the close. That strength suggests a bullish recovery story is building there.
And sovereign metals, that showed a different kind of strength, didn't it?
A very different kind. Sovereign metals showed strong relative strength all day long, and it was coupled with a bullish RSI divergence.
Okay, so for anyone listening, give us the quick and dirty on RSI divergence.
The stock price made a lower low during the day, but the relative strength index, which is our measure of momentum, it actually made a higher low.
So they're moving in opposite directions.
Exactly. And that separation suggests that the underlying selling momentum is just fading away, even with the lower price. It's a sign that the sellers are exhausted and that rally into the close is much more likely to hold.
So the big insight here for you is that while the indexes were going nowhere, capital was aggressively moving around under the surface. You've got confirmed weakness in AXT and confirmed strength in sovereign metals.
And these are the specific high-probability setups that you find on a quiet tape. Don't trade the index chop, you trade the confirmed signal.
These high-volume day one moves are what set the table for the day two momentum plays.
And those offer the best reward relative to your risk, but only if they're executed correctly.
All right, so what does this all mean for tomorrow? Let's move from today's very cautious close to tomorrow's open. We need to focus on asymmetric trades. We need defined levels to trade against.
And the options market gives us the most immediate barrier for that.
Which is the gamma wall.
Exactly. We need to identify that gamma wall. And just so we're all on the same page, let's quickly define the mechanism. The gamma wall is a key option strike price, usually with a ton of net put gamma that acts like a powerful magnetic force.
So how does that work in practice? What's the mechanism?
Well, the market makers, they're forced to hedge their short options positions around that level. So they effectively become buyers below the wall and sellers above it.
So their own hedging activity creates this temporary floor or ceiling.
It does. So let's use our hypothetical example. If the S&P closed near 5,100 and we see a heavy put wall, a huge concentration of protective options, at 5080, that 5080 level is the line in the sand.
That's the key level for tomorrow.
That's the crucial line. If the market holds 5080, those gamma forces help keep it stable. But a decisive break below that level, especially on heavy volume after a bad CPI number, that could trigger more downside really fast.
Because the dealers are forced to accelerate their selling.
They're chasing the price lower, so you absolutely have to locate that wall before the opening bell.
Okay, now let's talk about capitalizing on those stock-specific moves we found. The day two plays. This strategy is so important because big news, good or bad, it rarely burns itself out in a single day.
Never. The market takes time to digest. And that digestion period, that's where the opportunity is, as long as you wait for confirmation. You're leveraging the continued momentum after a big, catalyst-driven day one move on outsized volume.
Let's walk through it. A continuation long. Setup one. Let's say Tech Innovator gapped up 15% today on some huge AI news, massive volume. How do we play day two?
Two high probability entries. Either a clean break of today's high that confirms buyers are still chomping at the bit, or, and this is better for risk management, you wait for a shallow dip into today's afternoon support levels that holds firm.
That dip gives you a better entry and a much tighter stop.
Exactly.
Okay, now the opposite. Setup two, a continuation short. Biopharma dropped 20% today on a clinical trial disaster. Again, extreme volume. What are the entry signals for a short trade tomorrow?
You're watching for a break below today's absolute low, which signals sustained panic or, my preferred setup, a weak bounce into prior intraday resistance that just fizzles out. You use that failed bounce as your entry, betting that the selling is about to resume.
And the execution really hinges on confirmation, doesn't it? You have to see the price action confirm at those key levels, the prior day's high or low, or, crucially, the VWAP.
Volume-weighted average price, absolutely.
And if the momentum isn't there, what's the golden rule?
If you take one thing away about executing these trades, it's this. Respect momentum. These are momentum plays. If they don't follow through quickly, or if that support or resistance fails to hold, you get out immediately. Keep your risk tight.
So let's tie this all together. Today's close confirms this market is. It's fragile and it's deeply bifurcated.
Very much so.
The broad market is relying entirely on that narrow leadership, those few mega-cap names, to mask the underlying weakness and the terrible breadth. But that very fragility is what's creating these specific high-volume opportunities.
And the whole market is just paralyzed. It's waiting for tomorrow's CPI data. That will be the single decisive factor. It will either push us through key resistance or trigger a cascade below that critical gamma wall support.
So as you get ready for tomorrow's open, what's the final provocative thought we want you to be mulling over?
I want you to think about that massive institutional divergence we talked about. You have foreign investors selling hard, a big risk-off signal, while domestic investors are buying the dip. All of this is happening while the VIX is inching up and the Nasdaq stability is built on the narrowest breadth we have seen in months.
Because the question
is this reliance on a handful of tech stocks a protective structure that's stabilizing the market? Or is it a massive concentration risk that is ready to unwind and unwind violently if tomorrow's inflation print spooks those domestic buyers? Your focus has to be on quality, on confirmed rotational plays, not on broad index bets.